Hey, good morning, everybody. All right. Last week we had one of those hurry up and wait weeks that extended longer than it typically should. And when we last looked on Friday, everything hinted that this week could be another hurry up and wait week. And we got a lot of reasons to anticipate that. But I'm gonna start it all with a warning. The warning is that it's easy to remember all those times when we went sideways for an FOMC week. But over the years, I've taken the time to mark these down. And what's nice about it is you can go back later and you can look at what it did during that week. Not where I want to go. Let's do it some way a different way. So when you know where the FOMCs happened in the past, you can evaluate what happened that week. So I Googled some events like CPI, PPI, non-farm payroll, got all of the different dates for when these events happened and just marked them out on the chart. And what that gives us a chance to do is evaluate how many times we had an FOMC and we didn't go sideways. And as this is really helpful when you have the weekly expected move on as well, because then you can see when the new week started and what happened during that week. So here's a typical FOMC week. I know I'm zoomed in a lot, but just kind of orient yourself with where we're at. The new week starts with the gray line. That was the previous Friday's close. So this is Monday right there. And then Tuesday, not a whole lot happened, especially on Monday, right? We were mostly stuck inside of Friday's wiki area. So that was Friday's high, Friday's close, Monday's open, no real gap up. And we mostly stayed inside of this wick range here. We tagged the half of the previous day. It's pretty common, but we really didn't do anything on that Monday. On that Tuesday, we had a little rope-a-dope, never tested Monday's low. We closed inside of Monday's range. There's Monday's high. We closed on Tuesday inside of it. And then Wednesday, of course, FOMC day. Now, all that day, it got violent, another rope-a-dope. We tested the previous day's lows, tested its highs, and then on Thursday and Friday, and then from then on, because of what was said at FOMC, we rallied. So a typical week, Monday and Tuesday sideways into the event on Wednesday, and then whatever they say at FOMC is the ripper up or down. I could jump into so many FOMC weeks that look just like that, really, again and again and again and again, without cherry picking at all. Monday, barely outside of the Friday, Tuesday inside of Monday, and then FOMC, and it happens over and over, right? But don't think that it has to go that way. It's not guaranteed, fait accompli. We can have a Monday ripper that goes all the way to the edge of the weekly expected move on Monday. Now these are a weekly range, right? Just like it sounds, it's the weekly expected move. How far should we move for the entire week? And we can make the whole week's move in a single day. And on FOMC weeks, we can do that more often than you would think on a Monday. So we can get it out of the way really early. Now, I'm not finding one at the moment because it's just the way it goes, right? When you're looking for it, you're not going to find it. But trust me, I've got the data on it. We can have an expansion into FOMC that belies what we're supposed to get. Right? Here's one of those FOMC weeks. Monday was bullish. It closed at the high of the day. Tuesday continued the expansion. It closed at the high of the day. Then we had the FOMC on Wednesday. And then on Thursday, it continued the push. And Friday, we finally stalled out. So that's one example right there. And that's kind of what I wanted to remind, right? Is that, yes, we're expecting a hurry up and wait week because it's FOMC week and it's in front of a big event. And that's just generally what we do on FOMC week. But we just had a hurry up and wait week last week, and it lasted longer than it should have. The markets don't like to get bored. They get bored easily. They also don't like to spin their wheels, and they will just flush things and start over, or they'll trigger something to happen. Running to the entirety of the weekly expected move in a single day fits the bill for triggering something to happen. So I just want to caution that whatever else we see in the morning briefing today, and a lot that says we're supposed to go sideways, we have a history of making the whole week's run before FOMC even happens. So far today, we're just hanging out, chilling. It does highlight the hurry up and wait that we're anticipating. Small caps are up the most, around 0.5%. If this continues to do what we've seen in the last 2 months, small caps being up in the pre-market, then they stall out around the open, either keeping their gains on the stall or giving some back. And we would see a rotation out of those if it holds to form. And we would anticipate the NASDAQ picking up kind of the slack that we would get from it. The Dow is flat, so blue chips aren't offering us anything of value. S&P flat. Japan, China, everything is flat and just waiting, except the small caps. They were getting a little bit of juice. Bitcoin was up this morning, and yields are up, but yields being up is attributed to FOMC week. Bitcoin 2% move. I mean, it had to get a little bit of up, right, after the fall that it had. So it's not really offering much by itself. I like to use Bitcoin as a gauge on risk, but if it's only up because it fell a long ways, then that's not very bullish. We don't have big events scheduled today. Market Watch is a good website for that. It only does US markets and only the biggest events. The reason we go through so many different websites to look at these events is because there's literally hundreds of events that happen every day, every single day, and you will never get them all. You won't. I promise you won't. And you could try, but you would spin your wheels and spend your day hunting down all of these different economic events, and then you'd have to do it all again tomorrow. So we hit a couple of sites that have a unique perspective on the economic calendar. Market Watch only does US and only the biggest events. If it doesn't consider it a big event, it doesn't even monitor it, and it only does the US. FX Street does nations around the world and is really granular. It gets a lot of things, but it is not a good resource for events that kind of just pop up out of the blue, say like the president's schedule, speaking engagements, that sort of thing. Really comes in under the wire, and it doesn't do a good job with those. So if it's cyclical and it matches a predefined schedule and it's published well in advance, these guys get it from around the world. it's good to check multiple resources, right? Finance Juice is another one of those that does a really good job. And this one is oftentimes better for those short-term events that pop up kind of out of the blue. The president's schedule, speaking engagements of various Fed members, that sort of thing. They're also, these guys are one of the few that actually highlight when QRA happens. So, you know, a really big economic event that doesn't hit most economic calendars. Even with all of these, you won't have all of the events on the day. That's why we watch the clock. Governments are lazy and stupid. They will do what they do on the half hour or on the new hour, sometimes on the quarter hour. And I get it if you're one of the people who can't read clocks. The quarter hour just means 15 minutes. All right. So every 15 minutes, you have the opportunity for volatility and increased volume. Every 15 minutes. Now, if you want to just dial that back to 30 minutes and 1 hour, watch the clock. If an economic event was to come out that you didn't know was coming out, it would still very likely happen on the half hour, on the 15-minute, or on a new hour. Go back and look at the pace of the tape and volume changes and flow through the day, and you'll see that it picks up on the quarter hour and the half hour and the new hour. So rather than trying to find them all, find the bigger ones and then just watch the clock for the little ones. So today we don't really have a lot on the schedule. Finance Juice, FX Street, Market Watch. There's really not a whole lot here today. We've got some auctions in the front end, which we could just monitor the IRX on that one. We're getting a little bit out of Europe. Tonight, we're going to get a little bit out of Japan. And that's it. That's a very boring, slow, sleepy, whole lot of nothing because it's what we're anticipating, right? So a Bank of England, European Central Bank, by lunch, we're done. Now, tomorrow, we're going to get some more jobs data. And then on Wednesday, we got the FOMC. Oh, you know what? Look at there. We got something from the president today. A round table in the cabinet room. All right. So a little bit of risk this afternoon, 2 p.m. from the White House. Everything still looks like we're going to get that rate cut, even if it is very likely or quite possibly the last cut we're going to get for a little bit. That PCE data that we got really locked it in. So today is not anticipated to be much. We're in hurry up and wait mode. The call wall and the put wall did not move. They're in the same spot. kind of light volume, less than 50. We didn't really do much last night. A little expansion through the Asian session, got into Europe, and that died out. Europe mostly held underneath the VWAP, and now we're getting a little push above, but not likely to get through the cog line before the open, 68.92 or the Globex high. Relatively tight range, all things considered. We are still above the volatility trigger and zero gamma, which is down here, 67.87, long ways from zero gamma. We'd have to break the 20-day moving average to get to the zero gamma line. Now, it's been a really, really nice run from 65.50 to 6,900, right? Really, that's just fantastic. And there's a lot of reasons to be concerned. I mean, it's been that way for a long time, right? Seems like we've been in a defensive posture for most of the year. But if you let that defense keep you bearish, then you've just had your butt handed to you all year too. Hopefully, you've been able to capitalize on the long opportunities, because we've seen the market just get protected and bid up over and over and over and over again this year. But that's a concern for when we're at the lows and it looks like we're going to sell off worse. And that's not where we're at right now. We're not at the lows looking at a sell off. We're back up to a previous resistance level. And the idea right now is to try to identify whether or not we're going to get through that 6,900 and continue to go higher, or if we're going to reject here. The last time we got here, it rejected. So we know there's liquidity up here. There's a bunch of sellers. The question is, are those sellers done, or do they have more to sell? You can't see that from this chart. No idea whether they're still here or not. We need to see the pace of the tape and the flows and the queue when we get into that level and see how the trades are responding to have a better idea of what we're dealing with at this level. But it's not hard to figure out that it's very likely going to take more than one shot against this level before we make it through. So then the question becomes, what's going to happen first? Are we going to make it through? Or are the longs going to give up and reset and try again? Because that's generally what happens when we can't get through a particular level, right? We'll pull back. It's kind of like the analogy that I used in the past of a stuck door. You try to walk through a door and you find that it's maybe a swollen, it's a bit stuck. So what do? Back up and put your shoulder in it and take another shot. Push just a little bit harder, and then if it doesn't open, you figure something else out. So until we leave this range, we don't know if they've given up or not. Yesterday's range on this chart is relatively large. If we go on to the intraday, it doesn't look so bad, but from out here, it's a big range. So one of the things we want to focus on is yesterday's midpoint and whether or not we're above it. The midpoint is here, 68.82. 82 is an old cog line we don't use anymore, but it's one that I would keep on my radar. If we can cut yesterday's mid, we'll focus on the 3, which is our Globex low. We already tested that level and it held. Get through that, we got the volatility trigger, and then yesterday's RTH low, and then the full low. The full low is 68.50 ish. Nope. Yeah, 68.50. 55. It's close enough. Otherwise, if we get outside of yesterday's range, we got the 111 and the 1236. And after that, blue skies, right? Well, I shouldn't say blue skies. It's not blue skies. Just open range after that until we hit the next pivot point. And the next one would be 69.50. Clear path. 69.16 is the 1236. Then you got the cog line 69.32, and then the options level 69.50. And we can make that run this week today, or at least in front of FOMC, we can make that run. And that's what I wanted to warn, is that just because it's FOMC and I've got a lot of data saying that we should be in wait mode like we was last week, you can only have that wait mode for so long before the market starts to get a little antsy and just kind of does something else. Seen it happen before, and I would not be surprised if it happens again. And since I've been bullish, if I think we're going to run in head of FOMC, then I would be looking to the upside. The 1236 is 69.16. So if we can break Friday's high and get through the 1236, then we can expand into 32 and then 50. That'd be a heck of a way to start the week, right? Get a Monday run to 69.50. It's worth mentioning the other side, right? If my initial theory is wrong and we go the other direction, then what's the alternate bias? If we break Friday's low, then we're going to aim for the 10-period daily, 68.32 cog line, and then 6,800, which would get us down around the 20-day moving average. So, level by level, it doesn't matter which way it goes. If we break out and end this hurry up and wait mode, then we've got a trade plan. Cut the 4, then the RTH low of Friday, then the full low of Friday, then the 10 and the 20, or cut Friday's high, get through the cog line, and make it to the top. GTFO, all we've got to do is get out of the box. The problem is it's a really big box. We've had a heck of a run to the upside, which is why a lot of people aren't going to be looking to the upside, right? But some of the best moves to the upside is when we get to squeeze bears and they add to the buying, which fuels us higher and really gives us that kind of blow off top push. So if we want to squeeze a bunch of bears, then we need shorts to get in. We're not IX10 at this point. We're only inside day, and we're inside of a really big wide day, which doesn't really offer any compression metrics. We could stay inside of Friday's range all the way to FOMC. It doesn't have to go anywhere today. I'm just warning that we don't want to get complacent and think that we can't go anywhere today, because we absolutely can. This is the ADR levels for the day. Since we're basically flat, we don't have any edge on going to one side or the other. The average range is 92 points. So, staying inside of the 2 red lines should be our base case scenario today. That really should be what we expect, because it's FOMC week. And everything that I see says we should sit sideways and wait on the data. My argument is they tipped their hand last week and already did that. And so I don't believe it. This week's floor pivot is a lot higher than last week's. You can see last week's all the way down here. So we had a big change in the weekly floor pivot, which makes sense, you know, because we had a big change in price. We're still above it. That's bullish. Today's floor pivot is higher than yesterday's. That's bullish. Price opened on it, which isn't really bullish or bearish. We're holding above it. It doesn't owe us any move because we've already hit it. It's a very narrow floor pivot, but it's not as narrow as it could be. The width of this channel gives us implications for what to expect if we did get a breakout. Now, it's narrower than any of the other channels that we're looking at, but it could get so narrow you don't even see a channel at all. You just see the line. And it's not that narrow. But this narrow range says that if we break out, we could continue the breakout and really run. But it's talking about breaking out of Friday's range. So to even get that sort of breakout, we'd have to get to the edge all the way up here or all the way down there and then get the breakout, which is fine. It's totally doable. We can do that, but it's asking a lot. Just keep in mind that these channels don't make price break out. It doesn't make price run or not run and come back in. These channels just give us insight on what to expect if we actually did get a breakout. Should we expect it to reverse and come back in, or should we expect it to keep the breakout and continue to run? The very narrow channel says if we were to break out, it's likely that we would keep the breakout and continue to run. It is worth noting that the weekly channel is really wide. So if we were to look at the week's range, it implies that if we were to break out of last week's range, that the breakout likely fails and we come back in again. Last week, we had a really nice distribution until the end of the week. Then we started to put in a new footprint here. That's basically where we're hanging out right now. And we're developing it for this week. So this is really just a continuation of last week's footprint. Underneath that 68.70, we get back inside the value area of last week. That's this zone down here. And what's been on my mind is a little bit of a pullback for another leg up. Right, this was the range we needed to break. We finally did. We got a buzz beyond that. But it wasn't a very clean run back, right? The Busby owes us to the top of the range. We did that, had the little bit of an overshoot there, and now we're just stuck inside of all of this. So if that pullback wasn't clean and didn't give us a good run, how do you solve it? You do another pullback. If we're using OCR analysis, find a clean page here. Technical analysis comes in many forms. There's a lot of different styles out there. This is a lower high, so that's scratch, right? It was lower than this high. After this scratch, it's been higher highs. Today is live, so this isn't counted yet because this day isn't done yet. But we've had those higher highs. And after this low, which is a lower low, that scratch, it's been higher lows. Now you need two of each to have a run, to have a trend. So if you have two higher highs and two higher lows, then you've got a trend. We've got three higher highs and four higher lows. That's been our trend. It's simple, it's obvious, right? The problems is how Friday closed. That was a really weak close. And then this range that we have, that Friday wick, sitting inside of that Friday wick, we can get stuck there. But it's been a nice run. It's been relatively decent, all things considered. So even when we were sitting in that range, that IX10 all week, we were still building it up higher and higher and higher for the breakout. LinReg itself defines that relatively well. We can even take it to the last bull day before we went sideways. It still shows the slope. Sideways for 5 days, and the slope is still there. So it's not hard to figure out, bullish is the right play, but we've been grinding higher, and now we've got an event looming that could put us sideways again for 2 days. With this zone that we have here, 68.92, 68.70, it's really tight. It's 22 points. It's hard to believe that we could see the S&P hold a 22-point range for 2 days. If this was pre-COVID, oh yeah, we could totally do that. Because back before COVID, the S&P had an average daily range of less than 30 points. If we moved 40 or 50 in a day, it was a really awesome day because we didn't get very many of those back then. And between 9:30 and 4, you were lucky to see 12 or 15-point moves for the whole day. So we got the point of control up here with us on the TPO and the volume profile. This is 10-day, 30-minute. The profile is really ugly, but it's also really clear. We can see the structure below us, and we can see where we're hanging out, and we got to get through this sort of gravity that we've put into place, this range or this zone here. And the problem is, like we've talked about last week, when we're sideways in a range, nobody knows they're wrong yet. You can be bullish, you can be bearish, and both sides can trade that range because until we get out, nobody knows they're wrong. So when we were sitting in that range for a week, building it up, winding it up, anybody who was short had their stops outside that box on the upside, and anybody who's long has their stops outside the box on the downside. The concern is that we get a raid and a draw. So the sideways is the draw, then we raid liquidity, and we make a move into the other direction. So the breakout on Friday, if we'd have just broke out and then dumped, that would have been the raid. But we didn't dump. We broke out, got into that liquidity, and then we stalled. But we're still there. We didn't run out of time either because we hit it really early in the day. So, if it happened right at the close, that would have been different. It didn't. We're still there. We can also see how much volume we had up there. Remember, we've talked about this before. If we make it to the edge and there's nothing there, then the move got exhausted. It didn't get defended. So when we came into the low on Friday and there's nothing here, this shows that the sellers just got exhausted. We didn't run into a bunch of buyers. If we had, we'd see the same kind of volume that we saw across the high. Because when those buyers ran it up, the buyers didn't get exhausted. They ran into a bunch of sellers. What we don't know is, are they done selling? And it's very likely that they're not, right? So if we get into that zone again today, if we can break our own Globex range and get back up here, are we going to find those sellers waiting there? Or are those sellers going to move their orders up and sell it at a higher price? Sorry, guys, I can't chew bubble gum and walk, apparently. I can't type and talk. I'm broken. So this is what we want to watch for if we get that breakout today. The breakout being the range of the Globex. We challenge yesterday's high, see about that footprint, and then continue on from there. That would be a TPO chart, Tom, not a volume profile. A volume profile is a volume profile. A TPO is a TPO. What you want is something like a footprint chart so that you can look back and combine that footprint with the TPO and the volume profile. You can get that on TradingView, certainly not Thinkorswim, right? My jigsaw charts do that. I'm pretty sure that the bookmap charts do that, but since I don't have an active bookmap, I don't want to say for sure, but jigsaw can do it. TPO should do it, really. Thinkorswim's got monkey bars. It's not exactly TPO, but that's what they call it, monkey bars. So this is our week's range. We measured that on Friday, and we can see that the range that we measured was actually a little big. Through the day on Friday, it shrank even more than when we were looking at it on Friday morning. So more compression. Comparing it to last week's range, this is where we come up with. This is how much wider Friday last week was compared to this week. And last week was a sideways hurry up week, right? So we can see that compression, and now we're even more compressed. The nice thing about this weekly expected move is it's not math formulas like pivots, and it's not hand-drawn lines, which are always a bit arbitrary and subjective. This is based on right now money in the market. It's looking at the options that were traded for this week and using that to define these levels. So real live money actively positioned in the market gave us the data to define this range. I'm expecting a sideways week because that's what this is showing us. they were trading the idea that it was going to be a sideways week. That's what caused this. Now, whether or not we get that is, up for debate, but they were trading the idea that it was going to be a sideways week, just like last week. So we just need to be concerned about making the whole move in a single day or a day and a half. Say like this FOMC here, where we gapped up on a Monday and we ran almost to the edge of the weekly expected move by the end of Monday. And on Tuesday, we were there. Right? That was FOMC. Big gap up to start the week. So far, we don't have that big gap up, but we don't have anything. And it would only take a spark, since we don't have anything, to get us in gear and get us to move. We're above the 10-day, sitting in our sweet spot. We're not overbought. We're not overextended. We haven't moved too far, too fast. And we got a clear path to a 1.5% to the upside, easy, no problem. And a 2.5% move to the downside, again, easy, no problem. We could make that move and not even begin to consider being overbought or oversold. We can see that hurry up and wait last week with our distance from the 10 too. We just sat there doing nothing. The thing about sitting there doing nothing that we learned from the Laguerre, the RSI Laguerre, is that when a market goes sideways and does nothing, it's not doing nothing. It's building up energy. So if we want to measure energy, swift pullbacks from the dominant trend generate energy, and going sideways generates energy. There's an analogy I use with this. Take a ball and throw it in the air. Throw it like you're throwing it to the kids. You put energy behind it, and the energy that you put behind it is what makes it move forward. As it moves, it dissipates energy. And if you didn't put enough energy behind it, it hits the ground before it reaches the kids. So we know the ball moved because we put energy into it. Lots of times the market moves because we put the energy into it. But what about the other times that a ball can move? If you go to the top of a tall building and drop that ball off the top, as it falls, it picks up speed. Not losing energy, it's gaining. So we want to know when a market is moving, is it moving because there's energy behind it pushing it? Or is it the other kind of move? And that's what we use the Laguerre for. So we know a sideways market stores energy or builds energy. It's like putting your phone on the charger. Now that we've begun to expand, the question is, are we using any of that energy that we just stored up or not? All right, looking at what's down this morning, nat gas is down. It was up over, what, 11% in a 5-day period. Not a surprise that it's down a little. It's a little surprising that it's down as much as it is, but I mean, it needed to pull back. Plus 11% in a sleepy, boring nat gas. Not a surprise that we're getting a little bit of reflexive puking there. The Mag 7 down volume is down. That's a double negative. China, the Mag 7, all down. But I've got a lot of mag tools, and this is the only Mag 7 signal that I see that is down at the moment, and it's only down 0.25%. Our benchmark is at least 0.5%. So it's down a little, but a little doesn't count, and it's the only one. We should be seeing others. So it could be an outlier. The VIX is up. Bitcoin is up. The Mag 7 up volume is up. That kind of belies the mags being down, like we saw with that ETN. Uranium chips, tech, generically speaking. Miners are up, but not enough. We definitely have the capacity for a rally day just from Bitcoin and Mag 7 and chips. That's all it would take right there. But it would be better if we get that rising tide that lifts all boats, right? That way we get the market breadth come in behind us and really get everything moving. So it's a good start. We don't want a rally day led by pot stocks. That's just not good, right? So we want to see chips really step up. They're testing yesterday's high. But even if we can get through yesterday's high, we've still got this previous high to deal with. So a lot of overhead resistance in chips. Expanded tech, big gap up this morning. But look, it's just a print, like a little dot. That's not good enough for me in the pre-market. So we want to see this get fleshed out a little bit. Otherwise, one little dot, which you might not even be able to see in the stream, it's right there. Here's another example of a little dot that happened in the pre-market. So, we can close here, have a little dot, and then, be all the way down here somewhere. Same thing overnight, and then we're down here. So that one little dot, that's not good enough. I would scratch that one or not pay any attention to it. Retail, same thing, just a little dot up there. It shows you utilities is up, but it's trapped inside of that big drop Friday. So it's got to get through the half before it's even going to get any attention. Tech's not up enough, but at least we are putting in a few candles instead of just a little algo print. So it doesn't look so good once we go in and actually start examining some of the things that are up this morning. All right, it's likely we're going to see yields move for FOMC this week. So bonds week. 10-year up, that would be the base case. It doesn't have to go up much. It can just hold the line and not go down. TNX. And dollar's still trapped inside this 2.5, 3-day range now. Right, we're working on day 3, IX10. So GTFO, right? We got to get out of the box if we're going to get anything else done. The box at the moment is our own Globex range. if we can get out of that box, then we've got the RTH of Friday. And then we've got all of Friday. Let me back up because I don't think that's all of it. Yeah, that's all of it. So to the downside, we've got 3 levels just to get outside of Friday, plus our own Globex. To the upside, we've only got 2 levels, our Globex and Friday. That's it. Cog lines on each side. I already gave all the levels. All we got to do is start breaking it and go. To get through the Globex low, got to get through the Globex mid, and we've been hung up on that so far this morning. Testing it, and it held nice TRB back to the top. Problem is, that's all it owed us is back to the top, and we're already there. So whatever we're going to do, we could do it. Remember, it's supposed to be a sideways week, Monday and Tuesday into Wednesday's FOMC. That's what we're supposed to do, right? I just am adding the warning, be careful, because we did that last week already. Be careful, be safe, watch the clock. I'll see y'all tomorrow.